Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday evening in the US, July 10th, and it's good that we have given ourselves an extra few hours to record, as already, due to the flurry of tariff activity this week, we have already some more updates on that for you that I will supplement the slides with. So let's waste no time and let's get into the slides. So tariffs are on our mind this week. I've called this copper cooks and coffee boils, as both of these commodities are seeing pretty stark price rises in the aftermath of both actual tariffs and gestures around tariffs. And that has really come in a flurry this week on the back of a relatively quiet period in the run up to now around tariffs. We are getting close to the expiry of President Trump's self-imposed 90-day stay on some of these tariffs. There has been a flurry of letter writing to various counterparties and a real instigation to get more deals done. And this is then, we're kind of back to deja vu all over again when it comes to the Liberation Day style rhetoric. As usual, we will cycle through inflation, interest rates, equity markets, geopolitics, and another. And we talked about the coffee and the copper connection, but tariffs are more than just about economic policy now. It seems that perhaps emboldened by the relative resilience of markets and the fact that we are still reaching new highs in equity markets, the fact equally that markets and commentators alike have stopped reacting in real time to tariffs. It seems that the administration has been emboldened, and the recent volley of rhetoric around the tariffs on Brazil were linked to Brazil's treatment of Bolsonaro, the former president of Brazil. So clearly, quite a lot of political motivation and almost meddling in the affairs of another country, the imposition of the values and the beliefs of one administration on that of another. So I'd say we are in fairly uncharted territory, the fact that tariffs are now being used as a flex in this way. But that's the latest on Brazil. We'll see what actually transpires there. We've already seen in the immediate aftermath of this, barely 24 hours since, Lula in Brazil has seized upon Trump's tariff threat to revive his re-election push. There's a little bit of, again, more deja vu from the Canadian election, whereby the threat from Trump galvanized the country in favor, in that case, of Mark Carney. And it was actually a succession of the same political party. So it just goes to show how the collateral damages or collateral effects of President Trump's actions can be felt far and wide. We are approaching earnings season. We look at forecast what we can see and look forward to there. Very strong performance by Nvidia. I will speak a little bit about that. We're also going to go into an intriguing fear and greed indicator, which shows the markets are currently at peak greed, extreme greed, flashing red in that respect. And that is not completely surprising, given we have seen this FOMO behavior, this move into markets, despite some of the rather concerning warning signs that do not appear to be being addressed. We'll speak about what that means for markets, and again, back to portfolio implications. So where are we in markets? We can see that markets are still quite ebullient. We haven't got a specific inflation slide today, but inflation hasn't moved tremendously. We know that the general expectations around inflation are still about 3%. They've come down dramatically since tariff. That's in terms of the consumer expectation. We can see that even the settling of where the global rate is expected to be, despite some of these higher tariffs that we're seeing in the headlines, this chart on the left, most investors expect tariffs to settle around the 10 to 14% level. So not that much higher than the standard 10% tariff that we have currently in place. We can see that strategists are feeling bullish. They are now, this chart on the left, on the right, sorry, they are now moving upwards in terms of their expectations for the S&P. The various things they're citing for this would be the relative strength of the underlying components of the US stock market. And we can see that some of the expectations now are getting into new record territory, well in excess of the current 6,200 for the S&P. And whereas they have been higher, and there was an average forecast that was getting up to around 6,600 before we saw them dip in the aftermath of Liberation Day, but they are inching upwards now again. Another sign of ebullience is the focus of non-US acquirers now on the US market as a source of growth. We've seen this for some time. We know that there has been relatively stagnant growth in Europe, and many European multinationals have had to look outside Europe for growth. As well, the weaker dollar, of course, makes the US target more attractive again today. And a lion of the corporate America, Kellogg's, now said to be under the microscope from the Italian group Ferrero, the makers of Nutella chocolate, in talks to buy the US cereal maker for about $3 billion. So let's see if that passes antitrust muster or whether it's seen as been as critical to the national, at least the sense of pride. We know that there's been US Steel and that was connected with security. I don't know whether breakfast cereal falls into the same category, but that would definitely be a momentous time to see the final sale of Kellogg's, which has been a US institution for over a century. Let's look a little bit more detail at copper. We can see that in the aftermath of Trump's threats to put a 50% tariff on copper, prices have soared. Where will the collateral damage of this be felt? Definitely Chile, which is the leading source of US refined copper imports, followed by Canada and Peru in the distant third there. But definitely Chile is likely, the economy there is likely to be directly affected by any tariff action by the US. Getting back to the kind of source root cause of why President Trump is concerned about copper, a lot of it gets to the critical nature of copper as a raw material, and certainly as a raw material in data centers, in electronic components. And we can see that there's perceived to be a security issue around any essential material such as this. We know that these have been already pawns essentially in much of the global trade negotiations with China, with Ukraine, talking about rare earth minerals. So clearly, President Trump wants copper to again to be mined and developed in the US. And industry veteran Friedland, in this Financial Times quote, celebrated what he called a very intelligent approach to tariffs. He, of course, would be self-interested in that he does manage a large Canadian copper manufacturer, as well as being a strong supporter of the administration. But clearly, this is again reflecting the fact that US manufacturing has waned when it comes to copper. And in order to motivate more manufacturing in the US, a tariff would be necessary. Again, back to some of the collateral damage. We've already talked about Chile being a major source of imported copper. There we can see on the left how those markets have dipped in the aftermath of Liberation Day. This is MSCI Chile and MSCI Peru, clearly very dependent on the stance around trade by the US. So we have to understand that it's not always possible for non-US countries to march according to their own tune. And we can see, though, also that this was not entirely out of the blue. There have been some stockpiling going on around tariffs by traders in Europe, in the US. So this even though there has been a rise in prices, it perhaps could have been even higher had there not been that stockpiling that went on in advance. It's not just copper, another C, looking at coffee, threat of 50% tariffs in Brazil related to that political aspect I mentioned before has led to coffee prices already hitting a record high this year. That's been blamed not only on tariff policy, but also by the boss of Lavazza in Italy on hedge funds speculating on that. So a lot of demand supply issues always will be behind commodity prices, but not just our copper, but also our coffee starting to be very, very much felt. And that will press through then into more inflation. Although, as we've shown before, we don't yet know the actual impact of tariffs on inflation at this point. When it looks to why Brazil, it is more and more curious as to why Brazil has attracted this 50% tariff when we actually see that US has a surplus with Brazil, whereas it has a deficit with Japan, which has been hit with a 25% tariff. So there's not necessarily an economic logic or rationale behind some of these tariffs. As we said, in the case of Brazil, there does seem to have been a clear political motivation for that. This will, of course, only add to heighten the uncertainty that investors are experiencing when they think about how to model future tariffs, future trade policy into their actions, investments, and general connections with the US. So again, not necessarily relating to actual actual trade deficits or surpluses in place. Moving now to equity markets, we've had some monumental moves in Nvidia as it now reaches $4 trillion market cap, breaching the $4 trillion barrier, the first company in history to reach that valuation. There are a lot of slides on this page, but I thought it was helpful just to drill in a little bit into Nvidia as to see exactly why it perhaps justifies this valuation. What's different about Nvidia and why is it attracting just so much focus? If we see just in terms of it being the first company to break the 4 trillion barrier, the first is for the colorful chart on the top left, we can see that the other two companies that have come close have been Microsoft and Apple. Apple having much more of a struggle year to date, not outperforming due to some of its AI missteps, but clearly in the race still, but Nvidia breaking away. When we look at some of the fundamentals behind Nvidia, it's not actually in the it's not particularly, even though the sales multiple is high, it is not particularly, and certainly a lot higher than elsewhere. It's not simply the multiple that is behind this 4 trillion valuation. It's actually has been the revenues and the margins are relatively robust when it comes to Nvidia. It is interesting to see on the bottom left in terms of the sales multiple how it remains in a league of its own. If we were to compare the sales multiple, which currently is just below 30 times sales, compare that to the Apple, which is around 10 times, or the S&P 500 information technology at around 10 times, we see that Nvidia, at least on that metric, does look quite expensive. However, if we move to the top right, when we look at where the profit margin is, the profit margin of Nvidia has slightly come down from at the high 50s. It is still very much hovering around 50%. This again represents an outlier in the tech universe where it's not unusual to see margins at around 40 or slightly lower, but we have Apple just around 20%, Microsoft just short of 40%, but the mainstream index closer to Apple and around 20%. And that still dramatically exceeds the mainstream S&P 500 index, where margins tend to be in the teen level. So technology, information technology, still standing alone when it comes to broad margins, but ultimately Nvidia really striding ahead. And we can see that its forward price earnings multiple is in line with tech stocks. So because of these significant marginal benefits, because of the huge margin that Nvidia enjoys, whereas on a sales basis, it does look higher than its peers on a PE basis, an earnings basis, because of its substantial margins, it is in line with other tech stocks. Let's move now to fear and greed, just to get a read on sentiment, as it has been a bit of a disconnect or some cognitive dissonance as to why we see sentiment has been somewhat low, and we've seen consumer sentiment, CIO sentiment, business leader sentiment trending lower, while stock markets have continued to be at new highs. If we look at this CNN Fear and Greed Index, it's still currently flashing extreme greed as we get to the level of the S&P 500 reaching new gains. This is a change from a week ago when merely greed was what the meter was showing. Now we seem to have moved into the extreme greed. And what does that exactly mean? So there are lots of indicators that go into this fear greed indicator, and I think it's interesting not to go through all 7 or 8 in detail, but just to look at a few to see what exactly has changed in the recent months and why we would say that that indicates a very strong demand for investors to get into the market. First of all, looking at stock price breadth, one of the problems we had had with the market in the past was that it did seem to be not reflecting much breadth. It was very concentrated, very much focused on the Mag 7. That breadth has extended in the last, say, year. Has not always been uniform in one direction. Certainly when risk goes off, we do see that breadth comes in and markets get more concentrated. They tend to flock to their safety stocks, which in this case have ironically often coincided with the Mag 7. But now we're back to a breadth in markets again, which suggests again that more and more are coming in to markets, and it's getting quite interesting. We've also seen some record numbers in money market funds, and that is an indication again of the cash that's on the sidelines and why that, and this was actually on Twitter, Bill Ackman considered that a very bullish indicator. If we look again at the desire for yield, we see that junk bond spreads versus investment grade are quite close to all-time lows, suggesting that investor appetite for risk, as expressed by junk bonds, is quite high. Why would investors have an appetite for risk? Because they believe that default risk is minimal and they believe that they cannot lose. They are perhaps emboldened by the strong performance they've had to date. And again, with high yield bonds, the yields compressing like this versus investment grade, Generally, a credit analyst will perhaps be more realistic, more bearish relative to a general investor. So we will find that many credit analysts will be disappointed with the lack of an opportunity set now in junk bonds and high yield bonds because that spread has come in. If we look at the market momentum as a momentum indicator for greed, we can see that that is not quite at the extreme greed level, but it is still looking fairly bullish for the S&P with the 125-day moving average momentum very much ahead of that moving average. And moving outside the US, it's been very interesting to watch the divergence in performance of the copper prices within the US and outside the US. The blue line here indicates copper futures in New York, which have jumped the most, while copper futures in London, another major trading center for copper, have certainly increased but have not spiked in the way that they have in New York. This was a question I had to answer on Bloomberg this week, where my suggestion was that this just indicates that there is a dispersion between the US and the rest of the world. And there is a sense that not only can the rest of the world make its own deals now and will take advantage of the situation around tariffs to put in place its own supply chains to circumvent essentially the US as a supplier. This tariff news does seem to be really attaching to the personality that is spreading it and is not necessarily having a global contagion yet, although we can still see that at least there is an echo of the price movement, but not necessarily a large scale movement there. Back to where we see other risk assets, Bitcoin has been continuing its pro risk trend and really true to form that it has been moving in line with the rest of the other risk assets when it comes to the Trump's tailwinds essentially that have bolstered the currency. We can see that it's now at topping 112,000, which is a new high, and that is giving again more bolstering that momentum we spoke about before and certainly new sentiment. So that is our short update for this week. It has been a week where tariffs are very much back on the agenda. We are looking at earnings season. We spoke about Nvidia. Nvidia clearly will be leading the charge when it comes to earnings season. Many companies will most likely have spoken already about some of the uncertainty in markets, so they will have, I'd say, a fairly negative set of expectations, which can only be surprised on the upside. We are expecting a relatively robust set of earnings coming out here in the second quarter. They will reflect the choppiness that we've seen and the fact that many purchases were brought forward into the first quarter, so there will be some distortion there. I didn't provide a dollar chart, as it seems to be a bit of Groundhog Day in replacing the same dollar chart over and over again. The dollar remains low. That has not necessarily, as I said, it could be behind why some of the M&A activity has been high. It has not necessarily resulted in any necessary turnaround in terms of trade fortunes. We've had continuing murmuring about the Fed president. We spoke about that on last week's podcast about who the chairman would be. We know there are perhaps some shortlist emerging. However, that whoever this new chairman would be is not likely to have a very easy time when it comes to reducing rates, because we see that some of the momentum is very much behind rates remaining, inflation rates remaining high, tariffs with the uncertain wild card there. So a lot of news flow circulating this week. Most of it hinges on tariffs. I think we need to see how this is all resolved. And we look forward to joining you next week when we will have a special guest, Ewan Monroe. Thank you for listening.